So if you were looking at this candlestick like I was outlining it, if it was going to be bullish, the upper half of that to the midpoint should be doing what with price? Supporting it. If it trades to its middle point, which is the mean threshold, it indicates it's weak. So now what happens when you start trading up into that same range here? If you looked at this wick here, that's consequent version of that wick, halfway. So using the middle of the order block there and immediate rebalance, trading down to that, that's something that's tradable. So from target to the entry, there should be at least 20 handles run in between there. That should afford me the opportunity, or by theory, 15 handles as a profit objective. I don't like the 10 handle stuff. If you look at price action, 10 handles, it's this. That's static price action. Like it could just be moving around inside of a small little consolidation and not even going anywhere yet. In that 10 handles, you can get stopped out and be right if you're just trying to trade in, consolidations or time distortion, which is basically what we're seeing here. This is all time distortion, which means you have to sit and wait for them to give you something obvious. And right now it's not obvious, so you wait. So we've taken out the sell side here. Now here's the order block. This could become reclaimed order block, bullish, and run for the buy side here. A low that's taken out that low over here. Now we have this low that was taken out here, and we have clean highs, an undelivered half midway between the opening range gap high and low that has not been traded to today. That candlestick's low to these equal highs. That is definitely what? That's enough handles, right? And you start the clock from the time of entry. This is the candlestick number 2. Stop goes below it. Here's your target. And you just watch. It's already tried to go lower by taking this low out here. This low was taken out here, but this low did not take out that low. And we have clean highs that could be easily trailed to for buy stops that are used to more or less to protect the people that are short. So all the movement here, anyone that's short up in here or shorted there, that's actually a nice one. As the market went lower, they created these smooth highs here, and they took price below here. So traders that use this as a sell stop to get short, their short position is triggered to get them in when it went below that low right there. So retail's thinking that it's going to keep going lower because they've watched what? They've watched all this movement go lower. And by having that break out below to the downside like that, it provides them a trust factor that is, in a lot of ways, it's like bait. It should not go back inside of the fair value gap. If it does, that's fine. Everybody primarily has made money being short today. So it's reasonable to expect the market will do what? Roll against those positions that are in favor. That means the market's going to try to go against those that are in profit for the purpose of taking them out of it. So now what do you do with the information? This is what you do. That would be a primary example of just a first partial. Okay, so this would be first partial, and then this would be terminus. You're going to look for a first partial objective, and then you're going to look for a terminus where you're done. And you don't need it to trade all the way up to that mid gap. You don't need it to trade back to its old highs and attack these relative equal highs. We don't need that. So if you can frame the trade minimum, it's got to be able to move 20 handles. It's got to have at least this much movement potential where it can traverse from one price point where you expect to get in to where you think it's going to reach for. And it need not even go to that target. It has to afford you this much range. Now, we were down here. So this candlestick's low. That's the ideal entry. You're trying to get at that price plus 1 tick. That would be your ideal entry. I'm off by 2.5, so 2.5 handles. So that would be times $20. It's $50 difference between the actual fill and my target. The trade itself had basically no drawdown. From the time of entry, it literally was just hanging around and then took off. So how can we test that? Like, how can we test the amount of drawdown that we were in? Let me stay here long enough to see that minor buy side hit first. So what I'm essentially saying here is this is where I saw the price. As I mentioned, it's got to give you at least a 20 handle run of range potential. What does that mean? That's when that candlestick closed here, the very next candle, when it opened up right at that price and it started to drop down, I told you that you want to try to hammer it and buy at the market as it hits it. The low is what I'm anchoring this 20 pip range, theoretically, is what that means. So if I'm aiming for these relative equal highs as a first partial target, I believe that the market could reach up to knock out the stops that would be trailed lower on anyone that's short. So the buy side here is your initial draw from where you're trying to get in at with that fair value gap. So from this candlestick's high and that candlestick right there is low. If we think that it's going to go up here and we have this one single candle all by itself, it's sharing no space. The space between this candle's high and that candle's low is not being shared in any other candlestick after it's formed. And then on this candlestick, it came down and touched this candlestick's low. That candlestick is the same price. But can you see that that fair value gap is there? As soon as you see this candlestick close, the next candlestick, as soon as it opens up, my mind is immediately, bang, I'm watching that. I want to see that price tick. Once it books that price and offers it to me, mark it in. Plus one tick, obviously. So if it would have dropped down into the halfway point that makes this fair value gap, if it would have went down into the halfway point level, I would say hypothetically, this is where I would add. I want to know when the market is likely to move. It needs to move. And it needs to be on the basis of fucking time, Dave. Time, Mr. Anderson. You are in the fucking Matrix. And you're listening to fucking Neo. What time? What time is that candle? That's the 1050, 1110 macro. Holy shit. What did you say about them macros, ICT? What did you say? They're going to do what? They're going to run for liquidity? Oh, shit. What is that? Oh, shit. What is that? So right here, we have a very, very low drawdown entry. That's perfect. Over time, what you'll do is you'll see these gaps like this. And then you'll look and see if the number one candle has a wick. This wick right here. You want to see arrogance, motherfuckers? I'm showing it to you. This wick right there. There to there. This wick right there. Consequent encroachment. You won't need to place your stop loss below the number two candle's low. You can use one tick below the consequent encroachment of that wick right there because it's a gap. It's two layers of gaps. And it's already likely to only trade in the upper half. And if we see it trade down here like that and run up, if you started your stop loss there, you can roll it just below there. And then as you leave this high, then you can place your stop loss near the lower quadrant of the fair value gap. And that's this. You have to always grade your inefficiencies. So when you're bullish, the best perfect scenario is the market only drops in to the upper half of that gap and it leaves that lower half untouched. And that's indicating that it's extremely bullish. You're on side. You don't need to be afraid of getting stopped out. You don't even worry about your stop loss. It's there to do its job. What you're doing is you're watching price action deliver. Does it take this short-term high out? Yeah, it runs right to it. Opens. Does it overtake this wick quickly? Yep. Where's it drawn to? The liquidity I told you to. And it rallies up. And it consolidates. It's consolidating where? Inside liquidity. Inside the proximity of where these minor buy stops were. That's buy side liquidity. It's accumulating. What? New longs descended up into the minor buy side I gave you here. And they had this little move here. Now, I want to take you into a 15-second chart. All right, so here is the fill. There it is. All right, if you look real close, right where I'm showing my cursor moving around, you'll see the little caret thing pop up right there. You see that? That's my actual fill.